Chinese interest rate settings. So the 1 year loan rate remained the same at 3%. The 5 year loan rate remained the same at 3.5%. Then going on to Tuesday, we had UK employment data. So claimant count change, so those are actually people signing on, went from 17.1 thousand revised to 26.8 thousand. Average earnings 3 months over the year fell from 4.1% revised to 3.8%, and the unemployment rate fell from 5.2% to 4.9. Now, this is going to sound a bit confusing because said, okay, more people are claiming, but the unemployment rate fell. Now, remember, when we're looking at the unemployment rate, it only accounts for people who are actively looking for a job. If they're not actively looking for a job, and I believe it's at least 4 weeks, they're not included within this survey. You have people that's classified as economically inactive. And currently, that's around 40% of the UK are people who are not working, but they're not classified as unemployed. They're just economically inactive. So you have that aspect. So the labour market in the UK is giving us a bit of a mixed signal. But what it is telling us is that the labour market in the UK is loose. So what does that mean? It means that the employer is in control. Jobs are scarce, but people want jobs, which means the employer has more control over wages. This is why we're seeing wages fall. Because people are more desperate for jobs. There are few jobs. So the amount of vacancies to unemployment is actually falling. So we're seeing less and less jobs. And this is part of, we've actually been seeing this trend since Rachel Reeves upped national insurance for the employer. Anyway, moving on. And then we had US retail sales. So retail sales month over month rose from 0.7% revised to 1.7%, and then core from 0.7 revised to 1.9. So part of this we can say is attributed to obviously the higher energy and fueling costs. But in regards to core, that's still risen as well. But when we look deeper into the numbers, again, we start to see this expression of the K-shaped economy once again that I've been talking about. So it's those who are the higher earners in the economy that are continuing the high retail sales. And that's also the same in the UK. It's not people that are on the lower end of the spectrum. And then we had a speech by Trump. He was just trying to kind of talk things down in regards to the war. We also had Fed Chair designatee Kevin Walsh, who also testified in front of Congress. He got a little bit of stick from Elizabeth Warren and some other members, but it looks like he will be the new Fed Chair. Going into Wednesday, we started off the morning with UK CPI, so inflation, which rose from 3% to 3.3%, but core year over year fell from 3.2% to 3.1%. So what's that telling us? If you actually read the ONS report, there was actually a line in there that's basically said the jump in CPI, headline inflation, is solely to do with motor and fuel. So obviously petrol and diesel. However, because this war has now been prolonged, I believe it's been about 5 weeks, coming on 6 weeks now, we should start to see this follow through into more aspects of core inflation. First thing that is going to be hit that we're going to see in the next print is obviously higher airfare, but it will eventually go into food, clothing, etc., because it's going to affect transportation. And you've kind of seen it in PPI. So look, PPI month over month, the actual input went from 0.9 revised to 4.4. That's eventually going to be passed on to the consumer. And then read what I wrote earlier, somewhere in the Discord, regarding what Sainsbury said. Oh. Then going on to Thursday, we had a slew of PMI data. So we'll start with the most important. Well, Germany is important, but we'll take the overall EU. So EU manufacturing PMI rose from 51.6 revised to 52.2, but services, and it's predominantly a service economy, fell from 50.50 revised to 4. I want to actually go back to Germany because Germany is actually the manufacturing powerhouse of Europe. And you can actually see, even though it's still in expansion, it is contracting. So it went from 52.2 revised to 51.2, and it's expected to continue to fall as this crisis continues. Then going on to the UK, manufacturing actually increased, so going from 51 revised to 53.6, and services actually ticked up from 15.5 revised to 52. So the UK economy is actually expanding. You can actually see that reflected in GDP, which actually rose the last GDP print. Then going on to the US, manufacturing PMI rose as well from 52.3 rise to 54. And then services going from contraction to expansion, so from 49.8 revised to 51.3. So we can tell who's being hit the hardest by this crisis currently. It's actually Europe. And then going up to Friday, we had Japanese inflation, so national core CPI year over year, which ticked up. Obviously, again, that's to do with oil. So going from 1.6 to 1.8. And then US revised university consumer sentiment, which ticked up slightly from 47.6, which was the lowest on record, to 49.8. So again, we're seeing this divergence in the economy. The consumer sentiment is at all-time lows, but the stock market is at all-time highs. Now, we know that the top 10% of Americans own the stock market. So that's showing you again that only the top 10% are actually prosperous right now and actually doing better within the crisis. Everybody else is looking at their own conditions as unfavorable. And again, it's the same in Europe, it's the same in the UK, and most places around the world. Now, if we go into this week's event, we're expecting early in the morning, whilst we're all sleeping, for Trump to make an address. So brace yourself. And then going into Monday, nothing of major concern for Monday. Tuesday, we begin with Japanese unemployment rate expected to remain the same at 2.6%. We're expected to see Japan hold rates the same at 0.75. Then obviously we'll get the outlook from them as well. We also have core CPI, BOJ core CPI year over year, which is expected to tick up from 1.7 to 1.9, and then obviously the presser as well. Then going into later on Tuesday, we have ADP weekly employment change. Obviously hasn't got the forecast there for us as of yet, and then consumer confidence, which is a separate. This is the conference board. Consumer confidence. So it's similar to the University of Michigan. It's just a different body that's doing that. Then going on to Wednesday. We have US durable goods. It's not too important, especially this month. So durable goods, though, is expected month over month to go from minus 1.3% revised to 0.5, and then core from 0.9% revised to 0.4. And then the big one on Wednesday, we have the FOMC. You can never say that well, kind of tongue-tied. So the Fed, and this is the last meeting for Powell as the head of the Federal Reserve. So we're expecting them to keep rates at 3.75%. I am expecting the Fed and every other central bank to have the same rhetoric, which is we don't know how long this war is going to be. We don't know if the inflation is going to be embedded and it could be transitory. So we are not going to raise rates because price is already high, the cost of living is already high. Raising rates just hurts the consumer more in this type of situation. But they cannot cut rates because that exasperates inflation as well. So I'm expecting Bank of England this week, the ECB and the Fed to give that type of rhetoric. Then going on to Thursday, Japanese retail sales year over year expected to go from minus 0.1% revised to 1%. We don't really care. We've got rating dog manufacturing PMI for China expected to tick up going from 50.8 to 51. And then CPI for the EU flash CPI year over year expected to go from 2.6% to 3%. So you can see we've had a big jump. Previous was 2%. It went from 2% to 2.6%. Now I was expected to go from 2.6% revised to 3%. Notice that core is expected to fall from 2.3% to 2.2%. So again, that's telling you that it is solely related to energy, higher energy prices. And obviously that will eventually pass into food. So we'll see headline inflation remaining higher, but core should still lag until it becomes entrenched. Then we have the Bank of England's MPC meeting. Again, we're expecting them to hold the rates the same at 3.75%. We're expecting everybody to vote for a hold. That's what the market is expecting. And again, like I said, it's the exact same rhetoric. And then obviously we have the ECB later on that day. Again, we're expecting them to hold at 2.15% and exactly the same rhetoric. Again, then we have US GDP quarter over quarter. So that's expected to go from 0.5% revised to 2.2%. So quite a big jump. And then we have PCE data. I hate the fact it doesn't show the whole PCE. But we're expecting core PCE to actually fall. Probably expecting headline to actually take up, obviously, given the situation. Then employment cost index expected to tick up ever so slightly from 0.7% to 0.8%. Okay, and then the unemployment, initial jobless claims expected to fall slightly from 214,000 to 212,000. Obviously, we have the ECB presser later on that day. And then on Friday, we have Tokyo core CPI year over year expected to go from 1.7 to 1.8%. And then rounding off the last bit on Friday, manufacturing PMI for the US expected to tick up from 52.7 to 53.2. Okay, we can jump in to the charts now. Jump into the charts. Moyes, please let us know when you can see trading for you, please. Okay, cool. So we've got a jam-packed week this week, and there's going to be a lot of opportunities. So, especially those that are trading, please take notes, because there's going to be quite a bit of opportunity going on this week. So, as you can see, we've closed the weekly for the FTSE 100, the bearish candlestick, obviously bearish engulfing, but from this location, we don't respect it. You can see that we've now made a lower high. So you've made a lower high, and this might be the beginning of the reversal. The only way that we start to begin to push higher now from this point is obviously if we see a de-escalation of this war and the Strait of Hormuz actually opens up. We're actually kind of at a stalemate right now, and it's a bit of a dead zone. Nobody's talking to each other. It doesn't look like it's going to improve. The longer that happens, the more barrels of oil is taken away from the economy, which then affects growth. And this is why you're going to start to see equity start to get revised down, especially outside of the US, where earnings aren't as strong, for lack of a better phrase. So again, you should expect to see price come down. Then again, if we're following the same pattern that we've seen tonight, during the night, there might be a likelihood that Trump starts to try to talk up the market once again. But overall, we should expect to see some bearish action this week. Now, going into Friday, you can see Friday we actually closed with a bearish candlestick in between this range, still between 10,900 and 9,900. We're actually holding, we're actually in an EMA squeeze between the 20 EMA and the 55 EMA. If we start to lose this 55 EMA, then we start to come down towards support at 9,900. Again, this produces an area for a bounce, a double bottom. However, it's not guaranteed. Again, if we start to lose that area, then we just come down to the next level of support, which is this demand zone here. So that's what we're looking for this week. If we do start to hear some bullishness. We can push up early in the week from here to then come back down again. But the only way we start to push up, or I see us push up and break 10,900 in the near term, is if we get a full opening of the Strait of Hormuz, which currently that is not the highest probability scenario. Now going on to the ECB again, similar price action. Sorry, not ECB. The stock 600, similar price action. So we can see we closed the weekly with a bearish candlestick. You're kind of topping out at this level of resistance, the high at 630. So again, we should expect, if this doesn't get any better, for us to start to come back down towards 557. Again, Europe is facing a bit more constraints. I believe it was Goldman Sachs. They put out a report recently to say that they're actually cutting some of their holdings to Europe, and that's because of the oil crisis. As you know, Europe is one of the big importers of oil from the Gulf region. So it's actually impacting them. It's impacting Germany greatly in terms of the manufacturing as well. They did put in a report that I did upload today that they don't expect the drawdown or the crisis to be as bad as what we saw in 2022 with Russia, or the Russian invasion of Ukraine, simply because the gas problem was a bit more concentrated. However, it is going to be more entrenched within companies, not as concentrated as the gas issue, which is why, as a whole, they're not bullish anymore on European equities. We did close Friday with a doji. Again, remember that we do close in the EU/Europe earlier than we do in the US. So again, if we begin to lose those EMAs, you then start to come down towards that demand zone at 582. Going on now to the S&P 500. So S&P 500 closed the weekly, as you can see, with a doji. We're still above 6,900, this demand zone, and a psychological level of 7,000. If we actually look at the equal weight index, you can see that you've actually closed here with a doji. And if we actually look at RSP, which is the ETF for the equal weight index, you'll see that last week that actually sold off. So what is that telling us? That's telling us that, especially last week, that all-time high, that surge, that 1.28% that we put on, was attributed to AI, which is heavily weighted on the S&P 500, AI-related stocks, those hyperscalers, which perform. So your Mag 7s and those related hyperscalers. So the market doesn't have breadth. If that narrative begins to fade, then there is a high probability that the market begins to roll over. So again, just bear that in mind. If we then look at how we closed on Friday, again, you can see Friday we closed with a slight bullish candlestick, not much range in that. Again, we're still above that psychological level of 7,000, and this now demand zone at 6,975. So again, it's going to be based on the rhetoric. We already know that the Fed are going to keep rates the same, so there's not going to be any change there. The market is still pricing in for at least a 25 basis point cut by the end of the year. So we are still expecting rate cuts at some point this year. So the market is going to be driven by two things. If you continue to have strong earnings and strong forward guidance for most companies, this will continue to grind up, as well as that zero DTE trading. People actually trading the volatility intraday. Then also as well, any easing rhetoric or war rhetoric, or any opening, or if we do actually get the full opening of the Strait of Hormuz, things are going to explode higher, because that inflation premium starts to then get priced out of the market. Yeah. And that's what we should expect to see the same for the Nasdaq as well. So again, the Nasdaq closed slightly more bullish, obviously because it's the tech index. So you can see that we closed with a bullish candlestick, again, firmly above this level at 25,945. Again, just to remind you, when it comes to patterns, pattern is valid until made invalid. Gave you this 2 years ago, hit the target. We're now exceeding that target. So again, we've had this breakout, one candlestick, another candlestick. That's confirmation. But again, based on the headlines and where we are with this war, we can begin to unwind. US markets are being pushed higher by the AI trade and chips.
Bring the thing.
We've seen software pullback, but we've seen chips IGV, that ETF, has surged. So Nvidia, AMD, STX, MU, some of the smaller chips, Intel, etc., some of the smaller chip manufacturers as well. That's what's been pushing the market higher. If we look at the daily,
Michelle.
Friday, again, the daily close with a bullish candlestick. We're somewhat away from the EMAs now, firmly above this now demand zone. So again, we can get a back test, and again, based on the rhetoric, the war rhetoric, if we start to close below 26,085, start to begin to trade within this range as well. Okay. Now let's go on to currencies. So we'll start with the dollar. The dollar closed the weekly, as you can see, with a doji and an inside bar. We're still trading within this range between 100.145 and then 94.1.6. So again, the dollar will be used as a safe haven trade. Once we see any easing and opening of the Strait of Hormuz, we should expect a structural decline within the dollar. So the dollar isn't being bought because it's bullish. The dollar is simply being bought because it's being used as a safe haven currently. If we, however, start to see this war escalate to the point we're seeing boots on the ground, etc., you should expect the dollar to begin to rip. Currently, 100.145 seems to be a heavy area of sell-side liquidity, which is keeping the market down, despite people kind of picking up and buying at some of those lows. Now, if we look at the daily, you can see that we've been in this range since around about last year, April, between 100.40 and 96.645. We're firmly within this range. So again, for those that are trading from the demand zone, we're looking for longs. From supply, we're looking to sell the market as long as we're in line, obviously, with the rhetoric as well. You don't want to take longs from demand if the Strait of Hormuz is open. Prices is going to continue to move down. Well, for now, while there's uncertainty in what's happening, I expect that we're just going to continue to kind of oscillate in this range. A breakout above 100.40 sustained begins to become a bit dangerous because you can see that this is somewhat building a base. So it can easily begin to squeeze and push towards 110. So just bear that in mind. That's obviously if things get worse as well. So if things start to get worse in the US, or inflation starts to get crazy and begins to become entrenched, that's what we'll see. We'll start to see the dollar begin to break out. Now, going on to the fibber. As we know, the fibber is always going to move to the Dixie and close the weekly with the doji and also inside bar in between this range to 1.21610 and 1.12295. So we're in this range. Again, Europe is expecting higher inflation in the near term due to this, but whether it becomes entrenched or not is yet to be seen. So the market can go either way. If we hit demand destruction and we start to see recessionary signs, then the fibber will start to fall. If we start to see sticky inflation, then and the ECB then has to start to raise rates, then we're going to start to see the fibber increase. So again, we're at a level now where there is some level of uncertainty. Now, if we look at the daily. Friday, we closed with a nice bullish candlestick, not quite a bullish engulfing, but we're holding this 55 and the 20 EMA. Again, possibly making a higher low. So this puts us in a position to retest supply at 1.18710 as long as the dollar remains weak. So that's what I'm going to be looking for. A weak dollar sees us begin to push up back towards this zone right here, which might remain an area of distribution. So we could see something like this going into the week. Now, looking at the cable closed the weekly with a doji inside bar as well, still in between this range of 1.42545 and 1.30835. Structurally, we should see the cable begin to push up simply because of rate differentials as well. However, we need to see the nuance within the rate differential. So, a rate differential does not necessarily mean that the currency with the higher rate automatically will strengthen. We have to look at the reasoning why. And part of the reason why the rate in the UK is higher than all of the other G7 countries is because of the lack of confidence in the UK economy. It's not related to inflation. So when it's related to inflation and interest rates are expected to rise, that's when we start to see the currency appreciate. Why? Because I can borrow a cheaper currency to own this more expensive currency and capture the yield. It's a carry trade. In this example, the UK government is overspending. There's no fiscal restraint. And it doesn't look like it's getting better. The confidence in labor is weak. So this is why rates are higher. You're getting that premium above everywhere else. And everywhere else is obviously high because of the war, but the UK is slightly higher for that reason. There's also rumors that Starmer might be getting ousted. If that happens, the pound will fall. Because again, there's going to be a lack of confidence in the country and the government, which affects the currency. Rates will raise, but the currency will not raise in that situation. So just bear that in mind. Now, if we look at the daily on Friday closed similar to the FIBA. As you can see, we closed with a bullish candlestick, not quite a bullish engulfing, but bouncing off the 20 EMA. And again, we're making that a higher low. So again, we should, if we continue from here, we continue to push up on a weak dollar, we should then look to see price retest the supply zone. And again, we could see a rollover from there. So that's what I'm looking for going into the week. Now let's go on to gold. I'll start with the weekly. And I've actually revised or adjusted some of our levels. Wrong one, I'm in copper. Okay, gold, here we go. Okay, so gold closed the weekly with a doji slash slight bearish candlestick, also an inside bar. We're still holding this level of support, our bear case for 2026 of 4,700. If we start to lose this level, we start to pull back towards 4,250. Now, over this weekend, I uploaded some data to show you options positioning. And we can see that there were a lot of cool options on futures for gold with particular strike prices for December, 10,000, 15,000, 20,000. That doesn't necessarily mean that somebody is expecting gold to go to 20,000 by the end of the year. What that is signaling, though, is that someone believes that there is going to be a crisis and gold is going to push up a lot higher than what it is. So it's a hedge. It's a hedge against a crisis or a speculative trade that there is going to be a crisis. What is interesting is the amount of contracts that are positioned at that level. We also know that central banks are continuing to buy gold. So over the long term, you should expect gold to actually continue to rise. Now, in the short term, if real rates start to drop, or we start to see further escalation in the war, causing bond yields, especially US bond yields, to rise, that then puts a bit of pressure on gold. However, major pullbacks on the weekly or the daily is what I'd be looking to buy. Okay. We've not seen the end of the quote unquote bull market for gold. We closed Friday with a doji again, still holding this level at 4,700. If we start to lose this level, we come down towards 4,325. Again, you can see that this has been a strong level of demand previously. So again, this would be a high level or high probability area of buying. So that's what I'd like to see. If we start to see strength from this area, obviously because interest rates begin to fall, we start to see the opening of the Strait of Hormuz, gold could then begin to start to move to the upside quite rapidly. So again, that's just something to bear in mind. Now, oil, we're going to cover. We'll look at both quickly. So if we look at Brent crude, we can see that Brent closed above 100. Once again, closed the weekly with a lovely bullish candlestick. We're closed above 100. Front month contract as well is 105.33. Dated Brent, if you look at the AFY one, it's around 18. So if you add 18 to BCOU, so to the 105, you get 123 thereabouts. So just above 123. So that's telling you that as a whole, the average for a physical barrel being sold today of Brent crude is around 123 dollars. Now, depending on where it's coming from, we've seen reports of some oil being higher. I believe Russian euros is actually selling higher right now. I believe Saudi's sweet crude to Asia is selling higher than that. So again, oil prices are still elevated. I put in another metric in today, infographic, showing that we've actually been reported to be losing around 18 million barrels per day, which is, I'm not sure how true that number is, because they did say about 7 million barrels of oil from Saudi and the UAE is actually going via pipeline and then being transported via the Red Sea. And 20%, 20 million barrels a day is produced from the Gulf region. So you're telling us about 90 or something percent is missing. I don't know. But again, it's just showing you how large the oil crisis is. So that's what's keeping the market is backwardated. So what do we mean when we say backwardated? It means the front month or prompt contracts, as we call them, or the spot price of oil is higher than the future price. So down the futures curve. And why? In generally, the future price of any asset should be more. Why? Because inflation. So you have the inflated aspect of it. You also have to account for production, storage, etc. So that's all baked in. Whereas barrels today are ready to go to be sold. They don't need to be stored, etc., etc. However, when we start to see a market that goes from what's called contango, that's a regular market where the future curve goes from low to high, and it moves from one where it goes to high to low. That's called backwardation. So that's showing that there's some stress in the market today, or that demand is a lot higher today than it will be in the future. So, and that's what we're seeing because there's a shortage of almost 20% of the world's global oil supply, but demand and consumption remains high. Price then moves up. If we look at US oil, WTI as well, we can see also closed inside bar, inside bar but we also covered the British candlestick as well. We did see, however, we're not seeing it at the moment. At one point, there was the premium where the WTI was actually traded above Brent. And that's simply because you could get WTI at the point. Now that the US is starting to export more and WTI is more ready available, then Brent will start to see Brent obviously trade above, and that premium should begin to widen. Again, I'm not sure if you guys can see my watch list, but CL1, which is a prompt month contract, is 94.40 for WTI, and CL2, which is the next month's contract after, is 89.58. So that's a spread of 4.82. So again, that positive spread is showing you what the market is still in backwardation. Also, as well, if you look at this chart, this is the crack spread. So what is the crack spread for those that didn't read my explanation on that? This is basically how refiners make their money. So how it works is oil producers pump oil. They pump crude oil from the ground. This goes on the open market and is sold roundabout, often above the benchmark price. Obviously, it's called the crack spread, the 3-2-1 crack spread. The reason being is because they buy 3 barrels of crude at a time. Now, out of those 3 barrels, they then produce, obviously, oil refined products. From that, they produce 2 barrels of petrol, or as they say in the United States, gasoline, and 1 of heating oil. So when we say heating oil, that includes diesel, kerosene, jet fuel, fuel that is used, so heavy tar fuel, which is used for VLCCs, tankers, cruise ships, etc. Because for every 3 barrels of crude refined, only 1 is produced into heating oil. This is why you always see that the diesel price is higher. So when you go to the pump and you drive a diesel car, you go, why is diesel higher than petrol crisis or no crisis? That's why. Simply because more petrol is produced. Twice as much petrol is produced as compared to diesel. Now, this chart that we're seeing, this formula that we're seeing, is basically the cost. Is basically the markup, which is 1.55. Yeah. So if we add CL1, which is the price of the front month contract, so the price of crude, yeah, and you times that by Henry Hub's gasoline price and heating oil, so that's what the HO1 is. You get this number, which is 155.69. You divide this number by 3, and we get the margin. So what is that? So the margin right now is around 51. Yeah. So what am I saying in that? I'm saying for every barrel of oil that is bought at the benchmark, which is currently 105. So if a refiner like Venero buys 105, they then make off of those 3 barrels. So per barrel. So if 1 barrel 105, they then make 51. Obviously, that doesn't account for any operating costs, etc. So that's the gross margin. 51. The more expensive, or the longer this crisis gets, the more expensive that they can charge, obviously, for petrol and diesel, which widens that crack spread. Depending on where the refiners are, some will make money from this, some will not. So European refiners, Asian refiners who cannot physically get the oil, it's harder. You're not going to see the share price rise. The American ones that have access to WTI, The benchmark might be higher and they're paying higher for oil, but they don't have the issue with the supply. It's different. This is why you have tankers that are now going to the US to actually get oil. So the percentage of oil and gas, energy exportation from the US is actually increasing. The US is actually benefiting to some degree from this crisis. The nation is, the individual, the consumer isn't, but the actual country is. So that's what this is. Now, if you go back to oil, Brent crude, and we look at the daily, you can see the daily closed on Friday with the doji. So again, there's a bit of indecision within the market. However, what we should understand is currently the Strait of Hormuz is still closed. So they can manipulate what we call the paper market, this market, but the actual physical market story. Dated Brent remains high. It remains above $100. So Trump can use rhetoric. They can use Pakistan as a mediator to pump positive rhetoric about a possible deal, and Iran is close, and that will cause things to tank. But this is why I say on your insurance, when you see those big drops, you buy those big drops, because at the end of the day, the war isn't over. It continues, and the longer it does, the more entrenched inflation will get, and the deviation between the physical market and the paper market will start to close. So that's what we're seeing. And you'll see the same with WTI as well. You can see it closed with a doji, a bit more bullish, but an inside one. So exactly the same. Okay. So that's what we're expecting this week. We've got a lot of earnings this week as well, for especially for the Mag 7. So that presents, especially for the option guys and the guys that have done a day trading course, that presents a lot of opportunity for us. A lot of these positions that we hold as well. So for those of you that are interested in understanding your stocks, I'll give a bit more context with some of the earnings, a bit more breakdowns. Again, like I said, this year we're getting a bit more institutional with how we deal with certain things. So you'll get a bit more understanding at the breakdown, the link obviously to the investor summaries, etc. And then obviously just watch for the headlines as well. But it's going to be a volatile week. There's going to be a lot of opportunity. We've got 3 central bank meetings. You've got a slew of earnings for major companies. And obviously the Strait of Hormuz still isn't open. So that presents a lot of opportunity to make some money. So stay vigilant. But on that note, everybody enjoy the rest of your Sunday. Okay. Oh, yes. One more thing as well. So to encourage people from trading too early in the day and incurring potential losses, because volume has been extremely light in Asia and in the European London session. And that is because the market is being driven by the US market's earnings, but predominantly headline. And the market waits for what Trump and obviously Iran is going to say, etc., etc. So sometimes and quite often, some of the early moves are then being faded and unwinded during the US session. So until we start to see a bit of normalization, we're going to start to have the updates are going to be now the afternoon updates. So from 1. So again, I discourage, unless I explicitly give the trader my justifications to anybody, I explicitly discourage anybody to take trades prior to the New York session, please. But on that note, everyone, enjoy the rest of your Sunday.
Thanks, man. Appreciate it.